Something extraordinary just happened in the global silver market, and almost no one is talking about it honestly. While New York traders stare at screens showing one price, China is trading silver at $86 per ounce, and that difference is not a rounding error, it's a confession. A confession that the system designed to control silver pricing has fractured. Markets are only supposed to have one truth, one global price, one mechanism of discovery. But when two major financial centers disagree this violently, it means the system has failed. This isn't volatility. This isn't speculation. This is price deception being exposed. Tonight, we go into break down why China's $86 silver price proves New York's pricing model is no longer real, how this disconnect happened, and why this may be the most important signal silver investors have seen in decades. Welcome back to Boring Silver Mystery, the channel where quiet numbers expose loud lies. The silver market is built on the assumption that global pricing is unified and efficient. But that assumption just collapsed. When silver trades dramatically higher in China than in New York, it tells us that paper markets and physical markets are no longer speaking the same language. In this video, we'll examine how this divergence formed, why it couldn't be arbitraged away, and what it reveals about the true state of silver supply. This isn't a story about bullish enthusiasm. It's about a system that broke under its own weight. Traders exploit differences. Arbitrage closes gaps, and equilibrium is restored. That's how markets are supposed to work. But when silver holds near $86 in China, while New York prices lag far behind, either the metal cannot move freely, or the paper contracts in New York cannot be trusted to deliver real silver. This isn't inefficiency, it's structural failure. One of these prices reflects physical reality, and the other reflects financial engineering. The longer this gap persists, the clearer it becomes which is which. Markets can lie temporarily, but they cannot lie in two places at once, forever. China's silver market is increasingly physical. Contracts are more tightly connected to real metal, delivery matters, and industrial demand drives pricing. When silver trades at $86 in China, it reflects immediate availability, logistics, and real consumption. If New York silver were truly available at lower prices, traders would rush metal to China and lock in massive profits. That this isn't happening tells us everything we need to know. Transportation delays, vault shortages, and delivery constraints make theoretical arbitrage impossible. Arbitrage is the glue that holds price discovery together. When it breaks, markets fragment. Silver is now fragmented between reality and illusion. New York silver prices built on paper promises futures, options, swaps, and unallocated positions. These instruments create the appearance of abundance, but they don't represent metal sitting in vaults ready for delivery. As long as few people demand physical silver, this illusion holds, the glue that holds price discovery together. When it breaks, markets fragment. Silver is now fragmented between reality and illusion. New York silver prices built on paper promises futures, options, swaps, and unallocated positions. These instruments create the appearance of abundance, but they don't represent metal sitting in vaults ready for delivery. As long as few people demand physical silver, this illusion holds. But when demand rises globally, especially from industrial consumers, the paper market can no longer fake supply. China's $86 price is what happens when illusion meets reality. China doesn't need New York's approval to value silver. Its industrial base consumes massive amounts of the metal, and securing supply is more important than maintaining appearances. When Chinese buyers bid silver higher, they are signaling urgency, not speculation. They are paying what is required to obtain metal now, not promises later. This behavior tells us that silver is being treated as a strategic resource, not a tradable asset. That shift changes everything. Banks rely on predictable pricing models and manageable spreads. A $86 China price against a much lower New York price destroys those assumptions. Risk models fail, hedges weaken, and exposure becomes dangerous. Banks aren't panicking publicly, but internally, they are reassessing how much silver exposure they can safely carry. When physical reality diverges this sharply from paper pricing, it becomes impossible to manage risk without reducing positions. That reduction itself drives prices higher. Some will argue this is temporary, a logistics issue, or a regional anomaly. But history shows that sustained price divergence only occurs when structural shortages exist. Temporary dislocations close quickly. Structural ones widen. The longer China trades silver at elevated levels, the more pressure builds on Western pricing mechanisms. This is not a spike, it's a recalibration. Silver is no longer just an investment metal. It's critical to solar energy, electronics, medical technology, and electrification. Industrial users cannot wait for paper markets to resolve discrepancies. They pay what is necessary to secure supply. China's $86 price reflects this urgency. Industrial demand does not negotiate, it consumes, and consumption ignores financial narratives. Industrial users cannot wait for paper markets to resolve discrepancies. They pay what is necessary to secure supply. China's $86 price reflects this urgency. Industrial demand does not negotiate, it consumes, and consumption ignores financial narratives. Price discovery has effectively moved east. When the largest physical buyer set prices based on availability rather than contracts, the center of gravity shifts. China's $86 silver is not the anomaly New York's prices. The system didn't glitch. It revealed itself. China trading silver at $86 didn't break the silver market. It exposed it. It showed us that paper prices can lie, but physical demand cannot. Once reality asserts itself, illusions fade quickly. If you want to understand where silver is really priced, not where it's advertised, you're in the right place.